Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Joining us now is Tiffany Welding of PIMCO. Tiffany, welcome to the programme. Is there a stagflationary-like mix coming together here on the data that you see?
Yeah, so I think we're getting what we expected on inflation. We're getting some pass-through of tariffs. It looks like it's predominantly the firming categories are in goods, and otherwise things look a little bit better. I think the more concerning news from the data this morning is the jump in claims. It's been relatively contained despite the labor market, really slowing to a halt over the last year. And now the jump today looks a little bit more concerning, like we're moving out of just a period of very little activity or very little hiring or firing, to potentially some more separations. And that's going to be super concerning, I think, for the Federal Reserve. I agree with Mike McKee. I think overall the data this morning, I think, confirms a 25 basis point cut. There's probably going to be discussion around 50, although that's not our base case. And I think there's reasons if you continue to see this kind of momentum on the labor market, to get several more cuts in the back half of the year.
Tiffany, what I find interesting about the market reaction is that, yes, they're picking up on this idea that claims came in the wrong kind of upside surprise, as John was saying, and that the trailing average is picking up at a remarkable and alarming speed. But that longer term, we're seeing the 10-year yield now break below 4% for the first time this year. I mean, we're looking at a 10-year that is also responding. Are you changing your longer-term trajectory for U.S. growth prospects in the heels of some of these labor market revisions and the sort of negativity that we're seeing from the claims?
Well, I think that, just the fact that the U.S. Treasury market continues to be a hedge for macroeconomic risks, for riskier asset volatility, I think is why you're seeing movements, in the longer end of the interest rate curve. I think when we look at, sort of valuations, we think kind of intermediate sector looks attractive here, does still provide risk, against downside protection. And it's something that that we've been very focused on. So it's not surprising necessarily to me that you're seeing it in longer dated interest rates. I think overall on the economy side, we are really entering this kind of period of weakness, potential weakness. We'll see some fiscal supports that are offsetting the tariff effects, but they don't kick in until the beginning of 2026. Call it February, March, when consumers are starting to get really big refunds from retroactive tax cuts. But until then, we're really kind of in this period of weakness. And to us, the question is, some of these smaller and mid-sized businesses that are really having to shoulder the effects of tariffs, maybe they're not getting as much benefit from the one big beautiful bill tax cuts, can they really hold on here without firing people? And it seems like, maybe there's more concern around that, as we're watching the data.
Tiffany Welding of PIMCO. Tiffany, great to catch up with you. I know you've got to catch up with clients too, so thanks for making time for us this morning. Let's move in the bond market. This data is good for bonds. It's questionable for equities. Equity futures just about unchanged. We'll see if this move sticks, but at the front end of the curve, we're down 6 basis points. And as Lisa pointed out, we're down across the curve. And this is largely because of the way the Federal Reserve Chair set things up. Coming into September, he basically told us the following, that you could have a one-off effect on inflation, but not all at once. And the labour market data was concerning him, which is why we're seeing yields down this morning, because there's much more emphasis on what we're seeing on claims.
And it seems like the idea that you're seeing a pickup in layoffs, to Tiffany's point, raises the question of how companies are adapting to some of the higher input costs. I was looking at some of the specifics here in the CPI print. Airline fares up 5.9% on the monthly basis. So again, it talks about the K-shaped economy and how the Fed is trying to cater to people who cannot afford to pay that. Those who can are.
David Kelly of JPMorgan Asset Management standing by. David, you've been looking at the data. Just want your first reaction, please.
I think both with regard to the CPI and with regard to the claims, everyone should sort of take a deep breath and not overreact to them. On claims, key thing to think about is last week was a week that contained a Monday bank holiday, or a bank holiday you call it in the UK, but a Monday holiday, Labour Day. The unemployment claims data are notoriously bad in a week that contains a public holiday. They just have never figured out how to seasonally adjust that properly. So I think that's an overshoot on claims, and I would not be surprised to see that number come down next week. Now, it still fits into a mosaic of a slowing labor market, and I don't deny that. I think the economy is gradually grinding to a halt here, but I think that overstates the deterioration in the labor market. And then similarly on inflation, these numbers are very close to in line with what we thought. The big surprises were probably an increase in motor vehicle repair costs, 2.4% month over month. And then, as Issa was just saying, a 5.9% increase in airline fares. But remember, they fell very sharply over the course of the summer as airline travel was down. Now it's picking up again in this K-shaped economy. So overall, the economy is still moving forward slowly. Inflation's gradually going up. The economy is gradually slowing down. That's what we thought tariffs are going to do. It's going to slow growth and it's going to add to inflation. But I don't think it's nearly as dramatic as either of these numbers suggest this morning.
Well, David, let's just stay on the labour market story, because that seems to be what the market is moving on, at least initially. You think the claims data maybe overstates the weakness? Do you think the step down in payrolls growth overstates the weakness too?
No, I mean, we saw the big down revision yesterday or earlier this week. That was not a surprise. No, I mean, there's weakness. The thing is, as Jay Powell has pointed out, it's a very curious kind of labor market because we're having a huge reduction in labor supply at the same time. So this does not speak of significant, labor market weakness. I mean, it's still a tight market. It's still hard to find good people. But I do think it reflects the fact that businesses don't want to hire here. I don't think there's a huge ongoing jump in layoffs, but it's getting harder and harder to find a job because businesses are just frozen because they don't know what the playing field is going to be with regard to tariffs going forward. And I think that is, that's the biggest thing that I think people are ignoring here.
David, a lot of people are hoping that things pick up in 2026, that the growth story gets better, fueled by the rate cuts we're about to see. Speaking of things maybe that we underappreciate, something you've been talking about for a while, this tax bill, the kind of stimulatory effect it might have in 26. Could you just sort of outline that for us this morning?
Absolutely, really important. All these new tax cuts, getting rid of the tax on tips over time, increase the standard deduction and so forth, the sole tax break, all of them were made retroactive to January 1, 2025. But the IRS has not changed withholding schedules. That means that there's going to be basically a full year's worth of refunds on all of those tax breaks kick in the first few weeks of 2026 or first few months of 2026. That is the equivalent of big stimulus checks. Last year, the average income tax refund was about $3,200. This next year, in 2026, we think it's going to be over $4,000, with 70% of households receiving that. That is like one big stimulus check, one big lump of sugar put into the economy early next year. So if we can get to the first quarter without slipping into recession, there is, there'll be some stimulus there. But I do think that between now and then, the economy is going to be slowing in the fourth quarter.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to tech. Oracle shares higher in the pre-market after gaining the most since 1992 on an aggressive outlook. Waldemar Szlezak, of the global head of digital infrastructure at KKR, writing the following: "We're living through the largest build-out since the interstate highway system, a $10 to $15 trillion wave to rewire the global economy around power, compute and connectivity." Waldemar joins us now for more. Good morning, sir.
Good morning.
It's good to see you. Thanks for being here. Let's talk about these demand numbers. The demand we're seeing is real.
Yes.
Yet there is still this conversation about a monster misallocation of resources coming together. Where do you stand on that?
It is really the right question to ask. We don't see it, honestly. I think if you look at the fundamental spend relative to any other indicators from a bubble stand perspective, right? I mean, often comparisons are drawn to the dot-com bubble and, other housing bubble, etc. It doesn't appear so. And all of that compute that is ultimately being procured is getting consumed and deployed. I think the question that you're sort of leading into is there ultimately a business case for AI to be made? And I think there are a lot of great data points that would suggest, adoption is increasing, use cases are increasing, AI is enabling a tremendous amount across the economy and society, generally speaking. But there isn't a killer app, so to speak, that would suggest that the ROI may be justifiable.
I think the issue for many people as well who experienced the dot-com bubble, the bust, and the boom that followed really afterwards, it took a long time to find out who the winners were. And to begin with, you had to have everyone throwing money at the wall to see what sticks. And if we go through this process now, there are risks involved in that. How do you navigate some of those risks at the moment?
It is again another excellent question, which you would expect on a morning show from you guys. But I think our approach at KKR has really been pretty simple and disciplined, right? I think we clearly are one of the leaders in digital infrastructure and in the power ecosystem. Totality about $65 billion of capital that we've invested in that over the last few years. We have seen the convergence of those two mega themes, which is really interesting. I think we talked about this on the previous show, and I think it's now really applicable. You're seeing data centers are no longer about racks, it's about watts and megawatts of power compute, right? They're AI factories. And I think that convergence is really in place. So I think for us, we've been focusing on core and core plus markets for most of our compute. This is where ultimately data is being generated and processed by users. We focus on high quality customers. We do not chase yield on very speculative business models. I think we focus on fungibility in the use of these assets. It may have been enterprise 5 years ago. Today it's cloud, tomorrow AI, whatever may come next. And we ultimately are not making bets on field of dreams sites. It's really trying to focus on things that if there's a contract, high quality counterparty, we start building and deploying capital against that. That may be, all of that seems logical, but I'm not sure that's universally adopted in the industry, and I think we differentiate ourselves in that approach.
I guess that one of the fears, and John was alluding to it, is this idea that everyone gets incredibly leveraged to a couple of key names and makes really big bets for a long-term development at a time where we don't have a great deal of visibility into how this is going to be adapted, how this is going to be really transforming the economy, and frankly, the way that we live our everyday lives. So how do you hedge that concentration risk at a time where what you offer is the balance sheet to really deploy to these big blue chip players?
Yeah, I think you're right. It is almost a barbell strategy. I think if you look at the market and if you look at the performance in the haves and the have-nots, it's been sort of that barbell view. And certainly the Mag 7 are such an incredible driver of the growth. 30% of the U.S. spend on sort of AI is driven by those three names. $700 billion capex, 35% year over year. That's, by the way, $700 billion is equivalent to the entire spend for the fiber build out in the 90s. And we're now spending that on an annual basis, which is sort of incredible to think about the quantum of dollars. And so I think if you look at certainly the Mag 7, all of those names, pristine balance sheets, incredibly free cash flow generative, right? I think we are looking at certainly trading multiples and PE ratios and spend, but they're not overspending relative to the free cash flow that they're generating from either their existing core businesses or the convergence of AI integrated within their sort of existing business models. So you're right, you have a customer concentration, but the customer concentration is in fact with the highest quality names that you would probably want to do if you're investing in infrastructure from our point of view.
Where is the concentration in investment when it comes to data centers versus energy production? And this is another sort of key question at a time where people are building data centers as quickly as they can, with a question around DeepSeek and whether we can do this more efficiently with smaller data centers and less energy. And then we don't have the energy to actually fuel those data centers that are getting built. So where do you sort of stack up on sort of the dissonance between the development of those two?
And this is why it's such a wonderful time to really be alive and doing what we're doing. And certainly, an infrastructure investor wouldn't think about being in such a growth, industry. But it's really incredible. I think if you look at a couple of stats, we certainly have had stagnated sort of demand growth in the U.S. and the power industry for the past 20 years. That is now in a massive inflection point. Globally, the expectation is that data centers will consume something like 10% of global power in the next 10 years. By the way, that's equivalent to India by 2030. So if data centers were a country, it would be third after China and US. So certainly power consumption is decreasing. There are a couple of dueling factors. You do have efficiency, which is certainly driven by chip manufacturing, by algorithms, which is incredible. That's ultimately driving the cost of the delivery of the compute. So just in 18 months, if you think about the tokens which are being used for AI, I think of it, training for a marathon, we talked about it earlier, it's calories for AI. Token price has decreased 280x over the last 18 months, which means the adoption is increasing. If you look at about token usage, it's increased 4,500%. So certainly usage is increasing. I think if you just go back to your question, I think most of the capital today is being spent on data centers, and then there is an increased capex being put in grid and certainly power generation. So we're starting to see that trend line actually converging. But in terms of growth on an adjusted basis, it's really been those two that are probably the biggest drivers of the capex.
Is deregulation and getting rid of some of the red tape what comes when you have to make these AI data centers actually keeping up, though, with that capex spend you're seeing?
It is really interesting because sort of from a policy perspective, there's two dueling factors that are at a collision course. One is win the AI race globally, and the second is protect the ratepayers, which, in the US over the last 5 years, we've seen about 25% increase in power prices. And I think there are a couple of things that are happening, and including, I think, elimination of some of the red tape and streamlining of approvals. And I think those are great things by the administration to help enable the build out of this infrastructure. You can't just turn power on overnight. It's a 4 or 5 year cycle to build this infrastructure. And I think that is a great step towards that. Now, we're even cutting through the red tape, that is helping solve things 3, 4, 5 years from now. We have a gap in the next 24, 36 months. So what can be done? I think we can optimize the grid. There is dynamic line rating. There's investment in superconducting cables, which minimizes the loss. There are all sorts of innovative solutions, like the one we just deployed in Texas, where you co-locate a data center with a power plant. You have a way to effectively augment and draw electrons from the power plant. You have a way to support the grid in cases of emergency. And I think innovative solutions like that will help bridge us into the next phase when we see this massive development cycle of most likely natural gas power plants. And of course, at some point, we'll talk about nuclear. And nuclear will be 5, 10 years from now. I think that's the long game from a carbon efficiency and just the general efficiency of power generation.
There's a feeling on Wall Street right now, they're scared of this. They're saying maybe it's gotten over its skis. You travel to Silicon Valley, and there's just absolute abject euphoria. Can you bridge that gap, the idea that everyone's trying to poke holes over in New York and in San Francisco? People are just running around saying we can't invest enough?
It is interesting. I do spend time on the West Coast quite frequently, and it's incredibly energizing when I'm there and coming back, and you sort of have this wet blanket put on you in terms of all the skepticism. But I do think that there is a bridge there. I think there is now, a bridge in understanding of certainly, I think the technology mindset of, move fast and break things has to come and somehow be bridged in terms of building of this infrastructure, which is really a very different investment cycle, very different risk cycle, and a very different cost of capital cycle. And so I do think that we're helping bridge that gap in saying this is incredibly obviously exciting, but you have to obviously capitalize this in an efficient way. And by the way, the quantum of dollars that we're just discussing, whether it's $10 or $15 trillion, the annual spend, requires all sorts of different innovative, creative, and sort of holistic solutions to help build out this infrastructure. I mean, Oracle's earnings yesterday, which we touched on earlier this morning, were just terrific. It's incredible to see that. So you have $500 billion of backlog, and then the news this morning, that's another $300 billion of backlog. The numbers are starting to sort of seem silly. We're moving from billions to trillions. And, that amount of infrastructure will require many, many gigawatts of power, many, many gigawatts of compute. And that's why you see, power companies move up on that news. You see the chip manufacturers move up on the news. You see data centers move up on the news because it just suggests that we're still in very early innings of that investment cycle that is taking place.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to Tom Michaud of KPW, a Stifel company, for more. Tom, welcome to the program. Good morning.
Good morning.
Before we talk about this, let's just talk about what day it is. You were headquartered in the World Trade Center, lost 67 people that day. I want to spend a few moments with you just to think about what that day still means to you today and how we ensure that this generation that's now coming onto Wall Street who weren't alive that day, hadn't been born, how we make sure they don't forget either.
Correct. Thank you. Yes, we think it's very important to not forget. We said that day we were never going to forget. And there have been a lot of big pieces to what never forget means, because never forget means different things to different people. One of the things that we're doing is making sure that 9/11 isn't defined just by the people who flew airplanes into our building. Instead, I'm working with a group, 911day.org, which is a group that KBW helped found, to think about the resilience and the goodwill and the rebuild and honor the victims of that attack with that spirit. So we worked with Congress, and in 2009 we got Congress to pass a law making 9/11 a national day of service. And we think today there are going to be 33 million Americans who participate in a day of service to remember the victims of 9/11 and to remember the resilience and to remember the goodwill that it took to rebuild. There is one service project in particular that we support. We're going to be in 24 cities in America today. We're going to pack close to 9 million meals for those who are food insecure. We have over 800 corporate customers. It's our corporate partners in this. Next year, our aim is to try to double that for the 25th recognition and anniversary of 9/11, to continue to talk about what it took for America to rebuild after the attack. So you don't end up with 9/11 being 2 paragraphs in a history book. We're not going to let that happen.
You're contributing to a lasting legacy and making sure it's a positive one. So I think we're all right behind you, sir. And thank you for being with us today to talk about it. We need to talk about the broader business world too. We need to talk about what's happening with banking activity. Things are bouncing back. And you can see that and hear it in the words of Jane Fraser of Citi. Are you seeing that too?
So I've been a guest on your show many times over the last couple of years. The factors that were headwinds are now tailwinds. I'm about as optimistic on the fundamentals of the banking sector and financial services in general as I've been in several years. There's revenue growth. There's earnings per share growth. We're looking for 10% this year and next. The economy's okay enough. So that's all very bullish. And then there's the other stuff, which is rather than regulatory attention slowing down financial services, it's now resetting to where it typically is, which is one that's more supportive of growth. So the consolidation is going to restart in the industry. And the other thing is, I heard you talking earlier about how the market's at an all-time high, 6 straight days, I think, in the NASDAQ of records. The reality is you don't have the downside risk in the valuation for the financials. While the stocks have done well, they're still well far away from their historic norms. There still is a lot of valuation upside in the financials. And my experience is that when earnings estimates are going up, profitability is improving, the stocks tend to do well.
There's a lot to unpack there. I want to just hone in on the idea of the mergers and acquisitions. We have seen some of those announced in recent days, the PNC one coming just a couple days ago. Where are we in this process? How much more of that do you see in the next 6 months?
So my opinion is we are approaching the end game. There are 140 banks in America north of $10 billion in assets. 96% of the banks in America are below $10 billion are community banks. 96% of any number is almost all of it. There are very few banks above $10 billion. And I think the bigger banks are beginning to think about what the end game is going to look like. And they're being very strategic in thinking about these acquisitions. In the previous administration, it had an anti-M&A bias and wouldn't even give an answer to bank merger applications unless they were forced to. Now the administration's gone back to what historically had been the case, and they will give you an answer to a merger application. That's all the industry needed to restart the consolidation wave, and it's underway right now.
So what does it look like in the end? Is it just a couple of sort of the megas and then the sort of media megas and then everyone else?
To take the funnel real quickly, remember the non-banks. You were talking about Klarna earlier. Financial banks used to be half of the S&P 500 weighting in financials. Now they're a quarter of it. We think Ares is going to get added to the S&P 500 next. That's a very big $80 billion market cap company. So banks are a smaller piece of the financial services industry. They're competing with Klarna. They need to have the scale and the capacity to do that. Otherwise, the industry will evolve with 4 really big banks and then a lot of other ones that are much smaller. The best thing to do for the economy, in our opinion, is to allow these regional champions operations to get the scale to compete with the big four banks and then compete with non-banks. And I think our economy and Main Street America will be better served if that happens.
You sound incredibly optimistic about bank stocks right now. How hinged is that to a reacceleration in the underlying economy versus a secular shift?
Let me talk to you about the one thing that can stop it. The one thing that can stop it is credit quality. So this past week was the Barclays conference in New York. It was the last big channel check we get for the quarter. Everybody's saying the same thing. Credit quality continues to remain pristine. The industry is over-earning on credit at the moment. It shouldn't always be this way. So there will be a moment where credit costs go up. That shouldn't be the surprise. The surprise is for how long it's been essentially zero. So as long as we have a solid enough economy, then I think the bull story is very much intact. Usually, if we get a credit cycle, investors tend to sell bank stocks first and ask questions later. So the fact of the matter is we don't see a credit cycle on the horizon in the banking sector. So our view is that that is what's necessary, and 1.9% GDP growth is good enough to keep the fundamental story in play. And actually, the banks are talking about accelerating loan growth, which is a positive part of the story.
Can you just remind everyone, it's my favorite stat of yours, just remind us all of the top 10 mortgage providers in this country now, and how many banks are in the top 10 compared to, say, a decade plus ago?
So pre-global financial crisis, 8 of the top 10 mortgage originators were banks. Today, 3 of the top 10 are banks. Now, the question along that line, John, is did banks forget how to make mortgages? They were all primarily founded to make mortgages, and that is regulation. Because the response to every crisis is regulate the banks, which tied their hands, which is why the non-banks have so much market share. The right thing to do is to take the foot off the banks, let them compete with the non-banks, and I think you can do it without putting too much risk in the system, because the risk has just gone elsewhere, and it's gone outside the supervisory umbrella, and when we get the next cycle, we're going to find out if we were better off.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.